So, what is the deal with the US economy right now? Is it booming or is it about to go bust? I mean, that's the million-dollar question, isn't it? And if you're confused, you're not alone. The signals are all over the place. So today, we're going to cut right through all that noise, look at the hard data, and try to piece this puzzle together.
Okay, let's just dive right into the heart of the confusion. Get this. On the very same day, two major economic reports came out. On one hand, you've got a big national survey basically screaming that business is booming, hitting an 8-month high. But on the other hand, a really important manufacturing report shows activity it completely collapsed, plunging to basically zero. So how on earth can both of those things be true at the exact same time?
All right, to figure this out, let's play detective. We'll start with the optimistic side of things, the case for a strong, growing economy. And that begins with that big national survey we just mentioned.
Now, this report is what's called a PMI. That stands for Purchasing Managers' Index. The easiest way to think about it is like taking the economy's pulse. They go out and ask hundreds of companies a simple question: how's business? The magic number here is 50. If the score is over 50, it means things are growing. Simple as that.
So, what was the big headline number? A whopping 55.4. And let me tell you, that's not just good, that's solidly in growth territory. In fact, it's the highest it's been in 8 months, which tells us the economy is really picking up speed.
And this wasn't just a one-off, a random good month. July was also really strong. So you're looking at the most powerful back-to-back months of growth we've seen since way back in the spring of 2022. The people who put this report together even say this level of activity points to the economy growing at a solid 2.5% clip for the year.
But what's really crucial here is that this growth is happening pretty much everywhere. It's not just one part of the economy doing all the heavy lifting. You've got services, restaurants, tech, that kind of thing. They're expanding. And manufacturing? Well, manufacturing output just surged to a 39-month high. So both sides of the coin are seeing stronger demand.
So, okay, the big national picture looks fantastic, firing on all cylinders, right? Which brings us back to that big question. If everything looks so good from 30,000 feet, then where are all these warning signs, these whispers of a slowdown actually coming from?
All right, now let's flip the coin and look at the other side of the story, the data that's painting a much more concerning picture.
And here it is. Remember that Philly Fed manufacturing survey we mentioned at the start? Well, just look at this. It went from a pretty decent reading 1 month to, bam, a total collapse. It completely erased all its gains and dropped to pretty much zero. That is a massive red flag for manufacturing in that part of the country.
And if you dig into the details, it gets even more worrying. The index for new orders, which is a great way to see what future business will look like, it plunged 20 points. It actually went negative. And all that means is that businesses are seeing fewer new orders walking in the door, which is not a good sign for the future.
And look, it wasn't just that one Philly report. On the very same day, we saw that initial jobless claims, that's the number of people filing for unemployment for the first time, came in higher than anyone expected. That's another little crack in the foundation, maybe suggesting the job market isn't quite as rock solid as we thought.
So, here we are. We've got data screaming boom and data whispering bust, and it all came out at the same time. How is that even possible? Well, it turns out there's a common thread, a hidden clue, that actually connects these two completely different stories. Let's connect the dots.
So how do we solve this thing? Believe it or not, if you look really closely, both of these reports, the boom one and the bust one, they actually agree on one single critical thing. And what is that one thing? It's inflation. Persistent, rising prices. Yep, the strong national survey and the weak regional one, both of them are flashing warning signs that inflation is heating up again.
I mean, just look at the evidence. The big S&P report said that companies are raising what they charge customers, their selling prices, at the fastest pace in 3 years. And at the same time, the Philly Fed survey showed that the prices those businesses are paying for their supplies shot up to the highest level since May of 2022. See, both reports are telling the same inflation story.
Okay, so let's recap this weird situation. We've got a national economy that looks pretty strong, but we've also got stubborn, rising inflation bubbling up everywhere. And that combination? Well, it has a very direct, very real impact on your wallet, especially when it comes to the big stuff.
Let's make this super concrete. Let's talk about housing. Just a few years ago, back in August 2020, the average interest you'd pay in a year on a new mortgage was around $9,000. Today, that same number has tripled. It's about $27,000. That is a gigantic hit to anyone trying to afford a home.
And here's the other side of the problem. This is happening at the same time that the power of our paychecks is getting weaker, relatively speaking. What this chart shows is really fascinating.
It's basically asking, of all the money out there, what percentage is made up of people's wages? Well, back in 1975, it was 86%. Today, it's been nearly cut in half, down to just 44%.
And that right there brings us to the painful reality, the real crux of the issue for so many people. It's a double whammy. The cost to borrow money for a house has tripled, and at the same time, the money you're earning just doesn't go as far as it used to relative to everything else. Affordability is just getting crushed from both sides.
And that leaves us with one last, kind of scary thought. It comes from the chief economist over at S&P Global. He basically says, look, with this strong growth and rising inflation, don't expect the Fed to ride to the rescue by cutting interest rates. In fact, he says this data actually points them in the opposite direction, towards hiking rates even more to fight that inflation. And of course, that would make this affordability crunch even tighter. So, boom or bust. The crazy thing is, the data suggests the answer might actually be both at the exact same time.